So hello and welcome to episode 8 of the Let's Talk Mortgages podcast, brought to you by Green Mortgage and Protection. And this month, we are talking about the property tax and the changes following the autumn budget this year. So who better to talk to us about it than my very own accountant, the expert, that is Sean Maloney. Welcome, Sean.
Thanks, James. Thanks for inviting me. Expert, thank you. That's very kind of you.
Specialist.
Yeah, specialist. Yeah.
So have you done a podcast before?
Yeah, I've done a couple. I've done one in this very room. But yeah, I'm not particularly. It's not like I've got my own channel or anything. But yeah, I've done a couple, so we'll see how we get on here.
So yeah, obviously you're not new to podcasting, so we're gonna have a chat about all things property tax. Obviously, when we put this in the diary, this was before the budget, so we had a whole list of things we wanted to talk about. We'll try and box them off, but then there's a whole other box of things that we now need to talk about off the back of the budget.
Definitely. Let's say interesting budget has occurred, and there are a number of changes where people are taking a bit of a sharp intake of breath. Our general message is, there's going to be some things that we need to look at, but don't panic. I think it's been the overarching comment we've been making. Don't panic. There's ways we can do it, but it's just all about structure, really.
Who's the guy from Dad's Army where everyone's like, nobody panic?
Corporal Jones.
Don't panic.
There's a Hitchhiker's Guide to Galaxy, which starts off with don't panic. That has been our general theme is really, there's some things that we need to do, but don't make snap decisions, I guess is what I'm really trying to say.
Yeah, so before we jump in we're kind of saying off air, won't we, like a bit like when we was going through COVID, the new restrictions would come in and then details would then follow after that. So the main points have been released, but the finer details are still to come out and how people are going to work their way around it.
Yeah, absolutely. Legislation, the headlines have come out. It's the finer points really of legislation. And obviously there's been a lot of pushback on some of the, particularly you've seen, I know we're outside of property, but the farmers, the protests and some of the changes that are happening. Some of this is yet to be ratified, but as you said, the detail will probably come out a little bit later.
So jumping into like property tax, obviously, because a lot of people watching this will own their own home or own properties that they rent out as well. So obviously there's the four kind of like main types of tax for property owners, aren't there? So if you can quickly run through what those four are.
Well, obviously you've got at the outset you've got stamp duty, which some people tend to forget when they're looking at buying and funding. So stamp duty being the tax that you pay on the purchase of any property or land, actually brought in the 1694 to fund a war against France, if you believe.
All right, okay.
Proved so successful that it's just been carried on as a way of government to raise tax.
I'm going to make a note of that because people ask me, it's like, this stamp duty, like, what does it actually go towards? I'm like, do you know what, that's a great question.
Yeah, it essentially it went to fund a war.
Right.
But now they've seen it's been so successful, it's just been carried on for infinitum, really. It won't change.
Because normally, like, council tax, that goes towards the funding the police, your bins getting taken out, that sort of thing. Road tax, upkeep of the roads, which I don't think that's happening.
Well, yeah.
So I've always wondered why that comes in. I just say it's just a pound of flesh that the government can take.
Well, it is. Obviously, it proved successful in 1694, and it's going to get carried on for the rest of our lives. Well, yeah, definitely.
Still fighting wars today.
Still fighting wars today. Yeah. But that's essentially what was brought in. So that's the main one, really, when you're buying a property. Obviously, if you're buying a second property, you suffer that, and then the other taxes I'll guess you have to suffer is the really, if you're an investor, is the tax that you pay are either income tax, if you're gaining income, or capital gains tax when you sell. They're really the main areas that we will look at in terms of tax.
So obviously since the budget there's been some big changes on a number of those taxes. So first of all, stamp duty, the threshold has changed residentially, but that's not necessarily been a change, has it? That's just been that the holiday they put in place has now ended.
Yeah, during the Liz Trust year, shall we call it, or the Liz Trust period, because it wasn't actually a year. There was fun. Obviously, you saw the limits effectively double, and what's happening is they're going back to where there was before that change came into place. So yeah, there's a window where the stamp duty levels are going to stay, but then back to March 25, that's when they're going to go back to where they was before.
Yeah, so anybody that completes before the 31st of March next year, you still get the current holiday, as it were.
Yeah, you still, the rates as they are now, they're still being adhered to. It's after that date is when the changes will come into place, and obviously, if you are looking at something, now's the time to start looking, really, because to get the property over the line, not necessarily mortgage, but probably it's the legal areas which can tend to drag on, but have a longer process. It's time to be looking now. I would say.
Yeah, because your stamp duty is paid obviously on completion, so it's the date that you complete, not when you put the offer in or when your application started. It's when you actually complete. So I can feel the pressure getting mounted on solicitors around the country at the moment. Yeah,
and I think you saw that with the budget, was some of the prospective changes and people trying to almost preempt what was going to happen. Solicitors found themselves definitely under pressure to complete purchases, particularly for the buy-to-let market. I think you're going to see that again when we come to the January, February, March time next year. There's going to be that pressure exerted again.
Yeah, and obviously, again, on investors as well, that stamp duty has now gone from 3% to 5%.
Yeah.
When that announcement came out, we were kind of hoping that would tie in with the 31st of March, like the other stamp duty, but that was made that very same day, wasn't it?
It was, and I think that was quite surprising. Normally, with as you said, with changes, are normally quite concurrent, where taxes align. For that to have an immediate effect, I don't think anyone expected that.
Yeah, I mean, it caught a couple of our clients out. So they were the budget was on the Wednesday. On the Thursday, the new stamp duty for second properties kicked in.
Yeah,
we had people completing on the Friday, and they're like, "I now need to find an extra £3,000-4,000 from somewhere. Can I do anything?" And I'm like, Not really.
I mean, because Friday, as you know in your industry, Friday's like the main completion day. Us too. We had clients that had budgeted for a certain price, and because of the negotiations or the sheer volume that was put on the legal sector, they've ticked over into an extra 2%, which is chunky. Yeah, definitely.
But for those people that are maybe breaking the chain, so they own a house now, they're buying the new one, so for a period they're going to own two properties, they'll pay the additional there, but there is that window where you can actually claim that back, can't you?
Yeah, there is. If you're not essentially buying a second home, but you are just moving your principal private residence, PPI as we will call it, there shouldn't be any stamp duty on the second house, because effectively all you're doing is transfer between houses. If you do get caught up with that, you can definitely reclaim it back, but you shouldn't be really paying it in the first place.
Yeah, but if you do get hit with that tax, there's that 3-year window.
Absolutely. Yeah, absolutely. You can claim it back within 3 years if you effectively sell what was your second home, and you come back to one, then you're okay. You can reclaim the stamp duty that you've paid the excess.
So we'll try and keep the budget things to the very end. Okay. I know everybody's dying to hear that bit. But for our investors out there, then, so one of the biggest questions I get asked, which I am not qualified to answer, is I'm thinking of buying a buy-to-let property. Should I buy it in my own name, or should I buy it in a company? What would your advice to be for that question?
So I'll start off by saying this will be a general advice, because everybody's situations are unique, really. So to give a specific example, it's really hard. But generally, where you're looking at a limited company, where it works probably best is typically where you're a high-rate taxpayer. Obviously, with that as an individual, you lose the ability to claim the loan interest relief, where in a limited company you can get that. Also, if you're not looking to strip every last bit of cash out of the property, so you're not really using it as a second income, you're using it as perhaps a way to grow your future, bring your partners in, bring your children in, because with a limited company you can set different shareholders under what's called an alphabet share structure. Mm-hmm. Using a limited company that way is probably the most beneficial area. So yes, if you're trying to use it as a second income source, I would always probably look to be under an individual basis, but turning it into something for a future generation, or not necessarily stripping every last bit of cash out. Definitely a limited company is a vehicle to look at. As you know, the market in terms of lending for limited companies is expanding all the time.
Yeah.
So you don't really get compromised by buying in a limited company rather than an individual now. So generally those like broad brush approaches, if you're in that sort of sector, limited company is a vehicle that a lot of people are using now.
Yeah, I mean, we quoted for a guy this week who was in two minds whether to set up the company or not. Yeah. And I said, look, I can't give the tax advice, but here's what your mortgages would look like. Yeah. And years gone by, there'd be a good 1% difference in the rate from personal to limited company, personal being cheaper.
Yeah.
Whereas I looked this week and it's like 0.1, 0.2% difference. Okay. So like we are getting that close because, lenders know that because of these tax changes, a lot more people are now going through the limited company route. So that's a lot more competitive now.
Yeah, and I guess the reticence really for lenders at the beginning was with a limited company, as you may or may not know, the limited liability stays with the company. So I think their fear was the company's gone under, there's other creditors around it, and we're not going to get our money back. But as you just said, it's more prevalent now, and those cases, nothing's really been shown as an example of that to happen. So that's why probably lenders and the rates are more aligned now.
Yeah, and lenders now require all limited company directors to sign personal guarantees. Gone are the good old days when you could set up a company, buy all these properties and think, no, I'm not going to pay these back, and it's not my problem anymore. Directors now have to sign the personal guarantees, so if the company stops paying, they've got somebody then to go after, which I think is only a good thing. It keeps everybody accountable, and that is a cost that people then need to factor in. But I think as well that the size of the portfolio you intend to build as well, that'll be a factor as well.
Absolutely, and when I say like generational, it's when you are looking to grow it for the future and in the future. You know, things where you're looking at that, particularly when there's been, and I know we're talking about the budget later on, the changes that are coming with the pension. Some people don't like pensions, some people see property as their pension. So if you're going to kind of use it for that vehicle, then limited companies is generally the better route to go down. Yeah,
and I think, obviously kind of touch on the budget before we really jump in, is with all these tax changes around like stamp duty, the tax, capital gains and things like that, is for most of the investors we see now, because of those changes from 4 or 5 years ago, a lot more people are going down the company route.
Yeah.
So am I right in thinking that anybody that sells a property in a company is liable for corporation tax rather than capital gain tax?
Yeah, that's right. Yeah, and another good reason why some people will look at the capital gains tax element of being a limited company, because that stays at corporation tax rates, which currently are 19% on the first £50,000 worth of profit, be it a capital gain or income. That is driving a little bit of the people looking at the limited company as that format. And as you said, the capital gains tax is slightly different when you're in the two different formats.
Because I think the only thing that you don't get in a company is your personal allowance, which has been cut in half anyway. So it's not a massive loss, is it?
No. You're right. It's just above three grand. Where gone are the good old days when it was like 12,000 quid.
Yeah.
And so that allowance, you're right. It is kind of being diminished a little bit.
So we've looked at which route's the best for investing. So if somebody does want to set up a limited company, what would be obviously your advice for getting everything set up company-wise?
Forming a company, it's pretty straightforward nowadays. You can actually use formation agents online if you need to be. I'll probably the caveats we look at is always start looking at what I said before, which is an alphabet share structure.
Yep.
Gives you so much freedom to bring people in, to use bands, particularly if you're husband and wife, or you're cohabiting, or your life partners, anything like that. So have a structure where you have the ability to use different bandings, use different tax breaks. So prerequisite for us is, if you're forming a limited company, make sure you have an alphabet share structure in place and get the legals round it to make sure you can use that to its fullest ability.
Yeah, because people always ask us, it's like, do I need an accountant to do it? Because I know I can do it myself. I was like, yeah, it's going to cost you 13, 14 quid to do it on company's house yourself. But we always get people, set the company up, and there's so many things wrong with it.
Absolutely.
First of all is people have put their wife on it but not given them like a share. So it's like, well, that needs allocating.
Yeah.
For mortgage purposes, the company is meant to be a special purchase vehicle.
Correct,
so you'll probably tell me if I'm wrong, but is it SIC code, SIC code?
SI code, yeah. Standard industry code, I think, is the vernacular.
And that code on there basically tells HMRC what that company does.
That's right, yeah.
So we've had people think, I don't know which code to choose, I'll just put them all on. And then when we get the company, it's like, well, according to you're telling HMRC, I've got my own property in there, I'm going to let other people's out, I'm a builder, I'm going to do this, that and the other. There's four main codes that lenders like to see. The main one is 68100. So if people ask me, I would say, make sure you've got that on there, ideally nothing else.
Yes.
Because, most lenders, they look at that and say, well, this company is just for holding property. There are some lenders out there that will do trading companies, but very few. So again, would your advice be, from a tax point of view, to keep one business separate to another?
Potentially. I mean, if you're doing separate things, it's always good to have separate vehicles, because you never know if something have a problem in one, you don't want it to bring down everything you've got.
Yeah.
So separation of companies and certain sectors, definitely. It's always part of an accountant's job is to be a little bit cautious to say what could go wrong, how are we going to mitigate anything that goes wrong, and having separation is definitely something that's preferable. Yeah.
So obviously you've now got your company set up, you've got the right SI code.
Yep.
You've got your company bank account set up, you've got your shareholding. People say to us like, well, I've got no books for it. There's nothing in it at the moment. It's like, well, that's fine, because it is literally just a box to put property in. Until you put a property in there, it's not going to have anything.
Yeah, that's right.
But so obviously the tax implications of the rent that you're now generating. So talk us through the tax changes that came in 5 years ago about tax relief and the difference between personal and now limited company.
Yeah. So what you're talking about is high rate taxpayers now don't get the relief on loan interest, whereas if you're you're a husband and wife, the wife is a high rate taxpayer and the husband is a basic rate taxpayer, with the mortgage interest, the 50% that the wife get would not qualify against their relief if they're an individual.
Mm-hmm.
So what you've got is, if you've got the property on an individual basis, is you're paying your tax on an income tax basis.
Yep.
And you can take certain allowances off that, but for a high rate taxpayer, the loan interest is not, you have to add it back really. So as you've said, that has prompted a few people when they're in that situation to look at a limited company. Now, if you go into a limited company, the loan interest is available because the limited company is the entity that owns the property, not the individual.
Yeah.
And so you get a lot more allowance against the loan interest. And then the limited company will pay corporation tax on the profits it gets. If the directors then pull their money out, that's when that becomes into a personal level, and that's where the individuals would pay personal tax, but on a dividend basis.
Yeah, so obviously, limited company, say you're getting £500 a month rent,
Yep.
You then deduct your mortgage interest as the expense to bring that figure down.
Correct, yeah.
And then you would pay a lower amount of tax on that, because it'd be corporation tax as opposed to 40% as a higher rate.
Correct, yeah.
So that brings your tax bill down.
Yeah.
And then once you want to get your hands on that money, you then pay dividend tax, which is lower than personal tax as well.
Yeah, as I said before, each case is different, it's unique. So you've got to really look at where, if you're pulling dividends out, where that takes you on your basic or high rate tax brackets as well. Yes, you will pay less at the corporation tax rates, but then if you're taking a bigger dividend than your allowance, you get an allowance, a dividend allowance. If you're taking above that, the top rate of dividend tax is 33.75%. So you've got to be really careful when you're in that format, which is why I said a limited company normally serves best when you're leaving that money within the business. Unless you're drawing it back as a repayment of you putting money in, you've just got to be careful of how we look at it.
And I think as well, once you start getting to that sort of level where you've got a decent personal income, where you've saved the money to then start investing in property, you then have a property company. There's a lot of moving parts there, and that's again where we were saying earlier, where because of the changes that have now coming in, is I think we're going to see even more people getting advice before they even think about doing something.
Yeah.
To navigate what is now a minefield.
Yeah, I'll say the property sector is no different to any other traditional business. Without good foundation or good structure, you're on unsteady ground. So anything you do, you need to have a proper structure in place before you even press the button. It's something that we advocate across everything we do, and the property sector is no different. And you're right, more and more people are looking at limited companies as the way to hold property.
And obviously, once you now become a property investor, whether that was intentional or you have the intention of becoming what we call a professional landlord, we have a number of properties, or you've become accidental because you've inherited a property or something like that. Once you have a property that's not your own home and you're renting it out, you then have to submit yearly tax returns, don't you, to declare the income? Yeah,
you do. Whether you're an individual who's got a property or whether you're a limited company, both of them have to submit information to the HMRC. Self-assessment, if you're an individual, you have to declare on your self-assessment return and pay the tax. Limited company, you'll be covered under a corporation tax return that you do for the government, CT 600 it's called.
Yeah, because there's a lot of misconceptions out there about until I earn a certain amount of money, I don't have to declare anything. Is that a myth?
Yeah, it's a big myth. HMRC touched on the budget. I've just thrown a load of money at. I've been thrown a load of money by the government in terms of beefing up their compliance divisions.
Right.
They have now more access to all sorts of data. I'm pretty sure they've got access to all the agents' data. So it's really hard to sweep under the carpet. Let's put it that way, or accidentally forget. It's really hard to get away with a property that's not being declared, particularly for when there's a rent in place.
And I think as well, we say this to especially our self-employed clients when it comes to buying your own house, is paying tax isn't always a bad thing. If you're paying tax, it means you've made some money.
Yeah, and having a footprint that shows you can live as well as buy a property, makes your job a hell of a lot easier, James, doesn't it? I think that's...
it does. Yeah. No disrespect to builders out there or taxi drivers, but the ones that turn up in the really flashy cars, they're always carrying cash with them, and then I get their tax return and they've only declared £6,000 this year and they want to go buy a £400,000 house. I'm like, I'm good, but I'm not that good.
The Paul Daniels effect, I think. You just got to be careful. As I said, the access that HMRC has to so many data sources now is absolutely phenomenal. So you've just got to be careful. I mean, what's better, pay your tax or get a knock on the door? I know what I'd rather do.
Yeah, and I remember you always said to me, because obviously you've been our accountant for 6 years now, I think.
Yeah, 6 years, yeah.
And you always said to me, because everyone's like, what can I get away with? What can I put through? And you've always said, look, you've got to be open and honest. HMRC is like a bull. If you taunt it, it's going to come for you.
I don't know if I'm putting this on record yet, but that's the analogy of you. So hopefully no inspectors are watching this. But it is. I mean, you've got to. You can. I won't say you've got a license to not do stuff correctly, but as you've said, you've just got to do it within reason, really.
Yeah, you've got. If you've earned that money, you have to put that through.
Yeah, absolutely.
If it's an expense for what you're doing for a living. So if you're a plumber, you put your tools to. I think that's an allowable expense. Yeah. But I can't think of anything off the top of my head. But something that's not to do with your job, then that's not within that realm.
Yeah, basically the mantra of the HMRC is wholly exclusively necessary for your business is an allowable expense all day long. Yeah.
So we won't talk about allowable expenses because that could open a can of worms, and we've only got a few more minutes. So we've put off the budget long enough. So you'll have been inundated with messages, with calls and things like that since it's happened. So mainly for people buying a house or investors, what are the main takeaways from this budget?
Well, you've touched on it. I mean, the change in the stamp duty, the immediate change in the stamp duty, particularly if you're buying a second home, has been the biggest kicker for the budget. Then the information about the changing back of the stamp duty banding, they've been pretty big. And then outside of that, it's been some of the changes to capital gains tax, obviously for non-property assets. Those assets have gone up, which perhaps may lead people to look at property more, really. And then the other big impact has been the pensions, although, as we've said, we're still waiting for all the details to come out about that. So some people may look at, rather than putting money in pensions, using property as almost like a pension themselves. We have a split of clients that view property as a pension and clients that like pensions. There's no right or wrong. It's just what you fits best for you and your thoughts. The other thing in the budget, I think that's been mentioned, was the number of houses that Labour are wanting to build. Whether that'll have number one, whether that'll be achievable, and some people have talked in that sector don't think it is, but it could have an effect of putting more property on the market, which may change prices. So the taxation bit is the bit that is the headline bit, but there are things underneath it which are little subtle changes that people probably need to consider.
I think as well, like with any change, and I keep referring back to like 5 years ago when the mortgage interest relief came in. People always find a workaround, or it might change people's strategies a little bit to find a new tax efficient way of getting where they want to be. So what do you kind of see moving forward that people will either avoid or move towards?
Well, I mean, avoid's a dangerous word, James. I mean, one thing I will say is if anyone tells you there's a scheme to avoid stamp duty, then run for the hills, because there's no such thing. There are some schemes about which HMRC have broken and are actively looking at if they haven't broken them already. So there's definitely not any schemes really. The bits where we have seen people looking at different things, we've done a lot of work with people looking at trusts, about moving property into trust and the workarounds with that, which can have a bearing on inheritance tax and some savings on that sort of route. And we've had a number of clients look at, similar to trust, what's called family investment companies, which can do similar sort of things, although you've just got to bear in mind family. Sometimes having family in business is like oil and water. So people looking at that, and also one of the other things is where you've got people living together when necessarily only one of them owns a home. We've got a few people who've looked at, well, if the second person buys another home, it's their home. It's not classed as a second property, so that can have there's some little cute things that people can do to mitigate the tax, not eradicate it, but mitigate it. We're all about mitigation. Pay tax, but do you have to pay as much as you do?
Yeah, that's it. I mean, like I said, paying tax isn't a bad thing. It means you're doing all right. But not paying any more than you want to is kind of the overarching theme, isn't it?
Yeah, tax efficiency, not necessarily tax zero, but tax efficiency is what we're all trying to achieve. I think.
Tax efficiency and tax avoidance are two completely separate things.
Yes, very much so.
I think what we'll probably see in the buy-to-let sector is, because of the capital gains changes now, is it'll probably affect those older landlords who, again, 20, 30 years ago, it was tax efficient to have it in your own name. You're now getting to the end of your landlord journey, your investment journey, and you're now starting to offload those properties. Because they've got them in their own name, the threshold for capital gains allowances has dropped. The amount you'll pay has increased ever so slightly, so they will probably hold on to those properties for a little bit longer. But the people that are getting into property now, because they're going through the limited company structure, is their stamp duty will increase on day one. So I think we'll probably see less landlords selling up. I think we'll maybe see a few more new landlords get into the market, but hopefully because of other changes, obviously inflation's coming down again, hasn't it? Well, it peaks this month, didn't it? 'Cause we're in the run up to Christmas.
I don't think I'm not getting political, but obviously the budget was designed to maybe stimulate growth and have some bearing on inflation, and it seems to have, I think, because of the nature, it's just tweaked it up a little bit, but hopefully it'll settle down.
I think with any uncertainty, whether it's like, do we think it's going to be good, do we think it's going to be bad, people take a step back, and that's when things kind of feel quite rocky, whereas now we're starting to, dust is settling now, we're starting to see, okay, if that's what I'm working with, I'm now going to go in this direction. But I'm quite excited for next year. I think with inflation's finally back under control after Liz Truss from 2 years ago. It's been 2 years to get back where we are now. The base rates come down, but a lot of people ask us, like, oh, because the base rates come down, has my rate come down? Obviously, at the time of recording this, it's the end of November. But off the back of the budget, because of the uncertainty, a lot of lenders didn't do anything. So hopefully 2025, we should see some lower rates. People will then start to find workarounds about what they want to do strategy-wise, tax-wise. So I am actually quite excited about 2025.
Yeah, I don't think it is all doom and gloom. As I said about the budget, it is, digest it, don't make any snap decisions, and kind of roll with it. What can you do to make it work for you? So I don't think there's doom and gloom necessarily out there. It's just making sure you're structured properly and you're using everything that's available to you, really. Yeah,
so obviously getting a good accountant, first and foremost.
Oh, yeah, obviously. First and foremost, get a good accountant, get a good mortgage broker. Obviously, get a good solicitor. Anything that really can stop any lag in transactions, particularly when we're looking at changes in stamp duty, when it's going back to the previous levels. Getting all those ducks in a row before you even press the button is like critical. It's time critical now.
Yeah, and I think as well, like with most things, you get what you pay for. So people are like, oh, I'm going to go with this accountant because they only charge me this, but then if you pay for the advice you get, and that could save you thousands in tax, not just now, but over the long term as well.
Yeah, as you say with anything, you buy cheap, you buy twice sometimes. And you could, not necessarily play that in accountancy phase, but taxation and definitely structure, and definitely if you're looking to use it as a generational investment vehicle, it's getting the structure right, and normally that comes with better advice, really.
Well, that kind of brings me on to a point that I meant to raise earlier, but this is a great way into it. So talking about getting the advice right at the beginning is somebody who's got a buy-to-let property in their own name and then wants to transfer it into a company because they bought it a couple of years ago, should have put it in a company then. Let's talk about, obviously, the costs and the tax implications for that. So I've got a property worth 100 grand in my name. Quick numbers. So you pay
up there. We do maths, I can't believe it.
I want to put it into my limited company. So effectively, I'm selling it, although I'm director here, personal there, I am selling that to my company, aren't I?
Yeah, correct. And you have to really, number one, you have to really get a formal valuation. So first of all, you have to spring out for a valuation cost. It's legal costs. And then, depending on the value of the property, you're going to look at stamp duty as well, which you'll pay the additional rate because you're moving it into a separate vehicle. It's classed as a second property still, so you are going to pay that rate. So even before you've moved it, you've got to factor those in. And obviously, if you've bought it well and then you're moving it into an agreed level into your limited company, there's capital gains tax to factor into that as well. So before you look at definitely the tax efficiency on the income side of it, there will be a chunk of tax and costs that you have to factor in even before it goes into the limited company.
Yeah, I think that kind of like goes into, again, with all these changes, is thinking long term. Yeah. Like I personally see property as somewhere to hold wealth, like property holds value. People who get into property to make quick money, you're in for a nasty shock. It is a long-term thing. We've had people that have moved properties from personal to limited company, and then there's a capital gains tax bill to pay. You're now going to pay £5,000 in stamp duty based on this example. Maybe £1,500 on solicitors' fees. So again, that's where I then send people back to their accountant and say, you move in this one property, it's going to cost you, say, £10,000 in costs. Is it tax efficient to do that, or do you leave it where it is?
Well, yeah, exactly, because if you look at what you're going to save from moving it from 40% into almost 19-20%, if you're not taking the cash out, but it's cost you £10,000, you're going to have a few years worth of trading to even recoup what you've initially invested. So it is that. It's that granular, the detail that you have to go into to make sure what you're doing is the right thing. And
I think that's having the relationship with your mortgage advisor, with your accountant, kind of knowing like what your long-term goal is, like what your plans are. Because if you want to move into a company and then 5 years later you want to sell it, there's probably no point.
Exactly. As we've said throughout the podcast, it's about structure and it's about knowing what you want to get out of something. And basing your strategy around your game, really. True with most businesses, not just property, but knowing what you want to achieve now to get there, it allows us to give you the roadmap and the advice in order to get to that position.
Yeah, and I think don't let these tax changes put you off investing in property. Like, I mean, I'm 34 next week, and I don't look it. But, for me, I've got 30 odd years before retirement, so things like these changes, I'm probably going to have a few changes of government before I retire, and tax loopholes will change, and tax regulations will change, and things. I probably shouldn't have said loophole, should I?
I prefer regulations to loopholes. Thank you. Yeah.
Tax strategies will change.
Tax strategies, that's miles better.
And then, regulations will change, my circumstances, my plans will change, so not to let a little bit of uncertainty now put people off doing what they were thinking of doing.
Yeah, absolutely. Yeah. Don't make snap judgments. Look at the long game. Look at what you want to achieve. And as you said, there'll be, as time goes on, there will be changes, government changes, regulation changes, and it's just basically keep your head, keep your eye on the prize, and understand where you want to be and how you get there.
Yeah, I feel that the people that are panicking are probably the ones that it impacts them now, like those who are approaching retirement, wanting to offload some assets, that sort of thing. But then for somebody of my generation, or maybe younger, who are looking to get into property or buy their own home, is the cost for buying your own home, I would always say to people, is it's almost a necessary evil. It's like, if you want your own space, if you want a house with your partner, it's going to be your forever home.
Yeah.
What's paying £2,000 of stamp duty now? Because you'll look back in 30 years and go, do you know what? We've got a lot of happy memories here.
Yeah, we have there's a phrase in accounting jargon or accounting terminology. It's called opportunity cost. Mm-hmm. Is what are the cost of you having that opportunity? And sometimes you've got to take the cost to take the opportunity, and that across every sector, property being, as you just said, a prime example of it. There's going to be a cost, but what's the opportunity you will forego if all you do is look at cost?
Yeah,
it's all about opportunity.
Yeah, because we say the same with like rates as well. As like rates come and go. Like on average, they sit around 4 or 5%, which is what we've got now. We have been spoilt by COVID, believe it or not.
Yeah.
When rates hit like 1%, the stamp duty threshold was abolished, and we had the holiday and things like that. We had it so good for so many years. We've now gone back to what I would call normal.
Yeah.
And then like people younger than me, which you would feel that way because you've not known any different, are feeling really hard done by.
Because and if you can't tell, I'm slightly older than you, Jim. When I bought my first house 20 odd years ago, I think we paid 6.5%, 7%, which was seen as a good rate then. So you're right. I think, and as you say, date the house, not the rate.
That's it, yeah.
And that's just true. That as time goes on, there will be a fluctuation in rates, but don't make decisions just based solely on that.
Yeah, again, you're looking at a 30-plus year window of either investing or owning your own home.
Yeah.
If you're on a fixed rate, every 2 or 5 years your rate changes. So don't let what you think's a rubbish rate now put you off getting the home of your dreams, because 2 years from now the landscape could be completely different.
Yeah, absolutely. Yeah.
But yeah, there's another analogy I like as well. I can't remember where I heard it, but it was a long flight is going to have turbulence.
Yeah,
that's not a good enough reason to jump out the airplane.
I like that. That's a good one.
Yeah, I can't remember where I heard it, but I'm stealing it. It's mine now. But yeah, obviously things will get bumpy, things will level out. But if you're, like I say, if you're structured right, you're prepared, you've got a long-term vision, don't let that put you off. So just lastly, again, touch on the budget. Anything else that has changed or people should know about before we wrap up? Put you on the spot.
Yeah, put me on the spot. No, I don't. I think covered most. Obviously, outside of property, there's national insurance changes. That I think has probably been the biggest cause of concern for particularly businesses.
Yeah.
There's a tipping point as a business where the change in the national insurance rates will affect you or not. Obviously, the change to the national minimum wage, and those things are factoring things which potentially will hurt people's disposable income, because I know all these changes are not designed to be hit by the employee, but what you're looking at is an uplifting cost for employers, which sometimes can have an effect on wage increases, prices, which may change costs of livings. That seems to be the biggest issue. I won't say issue, but biggest scenario that's come out with the budget that's caused people to kind of take an intake of breath.
Do you think that'll be a bit like when COVID hit? Was it kind of clears the decks a little bit? So those businesses where profit margins are quite thin, or they've not maybe planned ahead, or they don't have cash reserves, or they don't cash flow so well, things like this might cause them to maybe improve how they do things?
This is putting me on the spot. Yeah, I mean, yeah, potentially, but I think what the main issue was is, and I know it's not going to come until April, is not just the increase in the rate, but also the reduction in the banding, which has caused a bit of almost like a double whammy. And I know we've had a bit of an extra allowance on it, but when you're looking at, the tipping point is probably about 7 or 8 employees. After that, when you're looking at those numbers, the incremental numbers that you'll see with the reduction of the rate and the increase of the percentage, it is causing some concerns, I think. And you're right, there may be businesses who won't factor in that, but I don't think nobody really saw that coming.
No.
I mean, it's going to be tough. It's not a bad time for, to keep an eye on people that you're close with or people that you know, to make sure you can do everything you can do to help them. But generally it's about looking at how can you streamline your business better, what tax efficiencies or savings can you make, I think inevitably there's going to be a rising of people's prices. I think it's just inevitable.
Yeah, and I think that kind of goes across the board because a lot of wages increased this year.
Yeah.
So we've had that, and then at first I was like, well, if people have got more money in their back pocket because national minimum wage has gone up, is interest rates are coming down, people have got more surplus money, they can start saving, they can go buy houses. But if it's putting a bit of strain on potential employers, we'll just have to wait and see what happens. But I think with any change, it brings about change.
Yeah.
So people change what they're doing, they diversify, they improve things. So touch wood, is that wood? I think it'll bring some positive changes both in terms of employment, personal circumstances, and property. Might be wishful thinking, I don't know, but
I think, and as I've said, we're still not sure what's happening with the finer points. But I think because some of the changes to property and capital gains, some of it has kind of left property alone. I think we might see a few more people looking at whether it's a viable option to kind of build their future and invest into that market. But as you say, we'll just have to wait and see what happens.
Yeah. So don't panic. See what happens.
Yeah.
Get some sound advice.
Yeah.
And then plan accordingly.
Absolutely. Don't panic. Structure. Know your goal and find a route.
I think that's probably the best place for us to finish, don't you?
I think so, James.
Well, thanks for coming on, mate. I really appreciate it. Obviously, you've been our accountant for 6 years. You've been fantastic for us, and I couldn't think of anybody better to talk to us about the budget and property tax and everything in between. So for anyone that wants sound accounting advice to structure and to plan, where is the best place to find either you personally or Lloyd Dowson?
So Lloyd Dowson, we're based in headquarters is in Bridlington. We've got a satellite office in Scarborough, but we've got clients all across the region, even across England as well. As I said, we're in Brid, but we're quite regional, but with national exposure as well.
So when this goes out, we'll obviously put Lloyd Dowson's social media into this, and then put the website on there as well. So if anyone wants to find out more about you, what you guys offer, and how to get in touch with you, we'll put everything in the show notes. And that
would be great. I mean, we cover every need of that a business has. Particularly got a really strong tax team, which are looking at a lot of the changes. And as we said, the structural side, any changes that the budget is doing. It's the work that we're really undertaking a lot now for clients. So absolutely, anyone who wants to contact us, now is the time really.
Yeah, I mean, you guys have been with us every step of the way since starting Green and Green, from just me in my box room at home to where we are now with staff and setting up payroll and contracts and our property business as well. So I would recommend you guys wholeheartedly, and we'll make sure we push everybody in your direction. And
that's amazing.
Thank you for your words of wisdom this morning. And 46 minutes, not bad. So who thought we could talk about tax for 46 minutes?
Yeah, no, and I'm sorry if you try. Well, I'm not sorry if you're trying to get to sleep, because this will probably put off. But thanks for inviting me. It's great to be invited to do this. It's feel honoured, and I'm feeling the love this morning, because obviously anything that you've done for us in terms of mortgages and not just business connections but familiar connections, you've been first class, and I wouldn't really recommend anybody else.
Thank you, mate. Appreciate that. Thank you for your time, and for those watching, that is episode 8. Episode 9 to be confirmed. We're looking to find another guest for the new year, so keep your eyes peeled for that, and we'll catch you again soon.